Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Lots to get to on today's show, so let me tell you what we have in store for the next half hour for you. First up, we're going to be talking about millennials and their increasing tendency to stay at home with mom and dad after they get out of college. This has been something on my mind. We've talked about it on the show in the past, and recent indications are that it's becoming even more common. So we're going to dig into that a little bit in the first segment. In the second segment, I'm joined by my partner at Randall Financial Group, none other than Matt Sweet, Certified Financial Planner and Enrolled Agent. And we're going to be talking about, well, financial ideas that might seem like a good idea, and it turns out they're really maybe not such a good idea. So we're going to go through some of those with Matt and talk about why people think they're good ideas and perhaps why they're not, in fact, good ideas. So we're going to spend a little time in the second segment talking about that. Third segment, I'm going to talk about some New Year's resolutions. This show should be airing right around New Year's, and I'm going to talk about New Year's financial resolutions, but I'm not going to have suggestions for your New Year's financial resolutions. Those are up to you. I'm going to tell you what mine are, and then hopefully, if we're here in another year, I'm going to revisit them and see how I did, but I thought it would be interesting to share them with the audience. And then in the final segment, we do have a question from a viewer, so we're going to dig into all that. So let's get started. And first up, read an article recently, and that's why I wanted to bring up again here on the show, about the increasing tendency for millennials to live at home with mom and dad after college age. So we're talking over 25, 26, 27, 28, 29, 30, and beyond. It's becoming more and more common for kids to stay with their parents. And the article, the particular article that I saw, it was actually part of a ranking in what states where it's the most common. So I'm going to give you a rundown of the top 5 states where it's the most common. You'll be happy to hear, for those viewers from Rhode Island, Massachusetts, Connecticut, or excuse me, from Rhode Island and Massachusetts, I'm giving away the plot here, that you're not on the list for the top 5. Connecticut is, so we'll get to that in just a second. But just some data that I thought was interesting before we put up the list. The number of children living with parents definitely on the rise as of 2016, which is the latest figures that were available. 15% of children between 25 and 35 living at home with their parents. Now, to draw some comparisons, if you go back to the year 2000, so almost 20 years ago, that figure was more like 10%. And if you go back to 1981, that figure was 8%. So 8% in 1981, 10% in the year 2000, and now we're up to 15% in 2016. So it's definitely increasing. The article was part of a survey that was done, and people were surveyed about why they're still living at home with mom and dad. And as you would expect, the number one reason is the cost of housing. It's just the reality that the cost to buy a home or to rent in many parts of the country becoming almost prohibitively expensive. I saw another article talking about 6-figure salary software engineers living in their cars in Silicon Valley because it's so expensive to live there. But cost of living is expensive everywhere, and that's the main thing that people are citing why they're staying at home with their parents even longer. Number 2 reason was repayment of student loans. Kids owe more and more money after getting out of college, and staying at home is a good way to bank some of that money so they can apply it towards student loans, which are more than they ever were before, something we've talked about. And the last reason, the one that terrifies me the most, is just figuring it out. They're still trying to find themselves and figure out what they want to do. I think that's great. I just don't want them to do it on my dime. So I'm very happy to have my daughter home for the holidays from college. I'm just hoping it's not a long-term situation. Let's put it that way. So let's look at that top 5 list. Throw up the slide really quick, and we're going to talk about yes, number 5. So our neighbors in Connecticut, number 5 at let's see, 1,091 young adults per 10,000 young adults living at home with their parents. Maryland is number 4. New York, number 3, with 1,199 young adults per 10,000 living at home with their parents. California was number 2, and the number 1 most common, New Jersey, where 1,252 young adults per 10,000 are living at home with mom and dad. Obviously, all those places, pretty high cost of living. So, all right, up next, we're going to be talking to my partner, Matt, about some good financial ideas that maybe aren't that great. So stay with us. We'll be right back. Welcome back to the Money Pros. Joined now by my partner Matt Sweet, is a certified financial planner with me at Randall Financial Group, and we're talking about this topic. I think this is a great idea to talk about because it's funny how these things come up. Quote unquote good financial ideas are things that people think are a good idea. It may seem good, like a good idea at the moment. Turns out maybe not always that great of an idea. And we could probably come up with a list of,
It didn't take me long to come up with these, yeah.
Right, and we're like, you want to put this one in, take that one out? So we don't have all day, so let's get to it. So we have a slide. We're gonna cover these one at a time. The first one we're going to talk about is store credit cards. Now, what the idea here is we want to talk about why people sometimes think these things are a good idea, the myth, and then we'll talk about the reality. So first one, store credit cards. Why would people think store credit cards are a good idea?
Well, there's usually some...
That's what I ask my wife all the time.
Yeah, there's usually some gimmick, like 15% off or something like that, or zero interest for a certain amount of time.
We're talking about UCOLs right now.
Right.
Yep.
So it sounds like a good idea. And legitimately you say, well, that sounds like a good idea. I don't... my other credit card is a higher percent or something like that.
The perception that if you don't apply for the card, you're somehow missing out or losing money on something or paying more than you need to.
You're missing out on the discount.
So why are these things so insidious?
Well, it's because things just never seem to work out the way they're supposed to. Once you have a card like that, you tend to spend more money on it. You carry a balance, and then after that, either at the introductory period where it's no longer zero interest, it may be a very high interest. And God forbid you do something like miss a payment, and then it becomes an absorbent interest rate.
I think one of the things people forget or don't realize for retailers, these store credit cards are a huge source of profit. Yeah. So they're not making money giving away 10% discounts on your first purchase. They're making money on the back end. One of the other things people don't realize is that when you say yes to that store credit card, you get the hit on your credit. So it shows up as a credit pull. Which can affect your credit score, actually. So if you don't need that credit, it doesn't seem like it's a really great idea.
If you already have a card, it's not really that useful to have a second one.
I have preached this to my wife, and she's generally very good about it, but sometimes she gets lured in. So I think message number one here, don't get lured into store credit cards, no matter how attractive the deal might be. All right, next one up. Borrowing from your 401k. Now this is, we can joke about store credit cards, and you can certainly run into some trouble. Borrowing from a 401k can also present some problems, but let's talk about, again, why would somebody think that borrowing from a 401k is a good idea?
Well, you have the option of, like a first-time home buyer can take a distribution or borrow from a 401k in order to buy a house, right? That seems like a reasonable thing to do. If it gets you into your first home, well, that would be good. But, again, things don't always work out the way they're supposed to.
And if you're actually talking about a 401k loan, it feels like you're borrowing money from yourself, right? There's no interest, there's no cost in theory, right? So it can seem like an attractive place to get money. What's the problem with that, though?
Well, essentially, the biggest pitfall of a 401k loan is if you actually change jobs or lose your job. It's instantly considered a distribution, and you get not only taxed on it, but penalized. You have to pay the tax penalty as well as the tax. So in those situations, it's dreadful. But even just in ordinary circumstances, it's just not an ideal way of financing a home. It interferes with your retirement savings, and there are better options like saving for a down payment.
So there's some opportunity cost here too, right? Because if I borrow money out of my 401k and the market goes up, I'm missing out on that cost. So I may be paying myself back for the money I borrowed, but there is a cost, a theoretical cost to that. Unless, of course, the market is correcting like it is right now, in which case you may look at it
might
as
come out ahead,
a great opportunity. But getting back to that other point about the taxability of the loan. When you take a loan from your 401k, you're not paying tax on it, and you're not. There's no penalties. But you could be happily paying back the loan and then get laid off, and all bets are off. You don't now have an opportunity to put the money back.
That's right. At the worst possible time, you're hit with a big tax bill. Yeah.
And we've seen that.
I've seen it repeatedly.
Plenty of times. So something to definitely be careful about. A lot of these are about debt. The next thing we want to talk about is using your 401k to pay off other debts. Why would somebody think that's a good idea?
Well, if you get into debt trouble, you got credit cards that are maxed out, or what, et cetera, and you're looking for a way out, and you've got yourself in a jam, and this is one way of getting yourself out.
You see that pot of money there. You see the mounting credit card bills, second mortgages, whatever it might be.
Right, and it's a matter of desperation usually, because it's available.
Sure.
Yeah.
Why is it a bad idea?
Well, I mean, again, it's not one of the reasons you're allowed to take money out of a 401k unless you're retired. And so you obviously have to pay the tax on the money coming out, but also you have to pay a penalty. So, I mean, many times it'll cost you 35 or 40% of the amount you took out in tax. So it's dreadful from that perspective, but it's also dreadful. You're harming yourself by taking out money from retirement at, usually at too young of an age.
So I think the first piece of advice here is don't get into debt trouble that would cause you to potentially want to dig in your 401k to pay it off. But if you are in that situation, there are situations where maybe it's your only option. And if that's the case, then you have to do it. But certainly worthy of looking at other options before doing that, because it's a pretty inefficient use of the money.
Yeah, it really is. And one of the problems is that if you do it once, you tend to do it again. So it doesn't solve the underlying problem that you have, which is a debt problem. It just makes it go away temporarily. And then, what happens? 5 years later, you find yourself back in the same situation, needing to take money out of the 401k again.
Right. I think it also points out another idea, which is that if you're putting money into your 401k, but you're not putting money away into savings that's more readily available or could be applied to pay down debt, then you really have to question the contribution to the 401k as maybe not the optimal use of your free cash flow. Let's talk about another issue with paying off debt, which is just the general idea of borrowing money to pay off debt. Now this one is just counterintuitive. Why would anybody think borrowing more money to pay off debt would be a good idea?
Well, many times you hear that you could get a lower interest loan. For instance, a home equity loan, paying off higher interest loan, or consolidating loans to make easier payments. So again, there's logic to that. But in the real world, sometimes the logic doesn't pan out. In this case, it's the same kind of trap where you take the easy way out, and it doesn't really help you. You've just shifted the debt from one pile to another. You've many times taken short-term debt and turned it into long-term debt. And you may have reduced the payment, but it hasn't solved the underlying problem. And it's just made you, again, deeper in debt.
So this is kind of a multifaceted thing, because you said a couple of things. One is reducing the payment. I mean, we see, I think in particular about auto loans and buying a new car, that certain dealerships will advertise, come on in, you can trade in your old car, get a new one, and we'll make your payment lower. If the world is about payments to you, you're not looking at your finances in the right way, because it doesn't necessarily, in fact, in the case of a new car, you cannot trade in your old car and get a new car and have it be less expensive. The world doesn't work that way. If the payment is less, it's because the time period is being pushed out. I think the other thing is the interest rate thing, like we're talking about refinancing a credit card. New credit card to refinance an old one is borrowing more money to get out of debt. Yeah, the math works, right? If you go from a 15% credit card to an 8% credit card, but if you have to know yourself, right? And if you're going to open up the new credit card but not refinance the old one, and now you got two credit cards you're going to load up that on, it's really sort of knowing your,
it's too easy to make a mistake.
Knowing your own disposition. Now this is an interesting one, the next one, which is getting debt canceled. Why in the world would getting debt canceled be a bad thing? So I'm going to answer the first part of my question, which is why would somebody think it's a good thing? Well, duh. If I have debt and I get it canceled,
you don't have to pay it.
Right. It seems like a great deal. So tell me why it's not a great deal.
Well, there's two major problems. One is that you have to pay tax on that. So you get a cancellation of debt, you're going to get a tax form from the debt agency that you're going to have to include in your income. So you actually get taxed on it. And in addition to that, you're destroying your credit. I mean, this is not an easy way out. If you, if you prize your credit rating in any way, this is going to really damage it. And
so if I owe $10,000 on credit cards and I negotiate with the credit card, we're not talking about a bankruptcy here. I think that's important to point out, right?
True.
We're just talking about we negotiated with a credit card company, so we can't pay it, and they knock off $5,000 of debt. I'm thinking this is fantastic, but I'm going to get a 1099 for $5,000 from the credit card company. I'm going to have to pay tax on that money.
That's right.
So while I might be out the $5,000, I'm going to owe some money to the IRS I need to be prepared for. The other point you're making, which is probably the even more significant point, is don't think that that's going to go unnoticed on your credit score, right?
Yeah.
Final one, paying extra on your mortgage. Now, this is the most common when we get this question all the time. We've talked about it on the Money Pros. Why do people think paying down the mortgage is a good idea?
Well, everyone who would love to have a paid-off mortgage.
Sure.
I mean, that's
live debt-free.
Debt
is
dream.
bad.
It's the dream.
Right?
And in fact, I have that dream. I
do too. Yeah.
So that's not a bad thing at all. In fact, it's terrific.
But with about 15 seconds left, why might it not be a good idea?
Well, a lot of times it comes down to cash flow. So, for instance, if you put money on your mortgage, you're not going to enjoy the enhanced cash flow as a result of that until you completely pay it off, which might be 20 years down the road. Whereas if you're paying off shorter-term debt or putting the money into other things, you'll be able to enjoy the results of the money much sooner. So it's basically because you don't have to pay any more than your minimum payment on the mortgage, so that it doesn't end up helping you until it's paid off. Which again, it's not a bad thing. It's just that usually there's better uses of the money.
But it's an opportunity cost thing also, in that if you're paying down a mortgage at 4% and you're pulling from investment funds that are averaging 6 or 7%, the math doesn't work, right? So you have cash flow issues and investment issues.
Yeah.
So living debt-free
like
would be attractive, but it's not the be-all and end-all. We'll probably do this. We'll do a whole nother list and have this conversation again. So Matt, thanks very much. Okay, up next we're going to be talking about my financial resolutions, and we're going to try to hold me to them for next year. So stay with us. There's more to come.
Welcome back to the Money Pros. All right, it's financial New Year's resolution time, and we've talked about that before on the show, some suggestions on resolutions you might make. I'm going to talk about the ones that I make. I'm a big New Year's resolution guy, losing weight, exercising more, all that stuff that I never do. But I also make some financial New Year's resolutions, and part of my world is kind of the cobbler's kids have no shoes. I'm always paying attention to other people's finances. Sometimes I don't pay as much as I should to my own finances. So I've got some New Year's resolutions surrounding my finances I wanted to share with them. So the first one is I'm going to start reviewing my property and casualty insurance. I get my renewal policies in the mail every year right about this time for my homeowners, my auto insurance policies, my liability policy, all that stuff. And you know what? I stick it in a drawer and I never look at it. I need to take some time to go through it, check my coverage, understand what I'm paying, maybe do some comparison shopping to see if there's opportunities to save money, call my agent, talk to them about different options. So it's definitely something that I need to stop procrastinating on and pay more attention to, because it's an easy thing to overlook once the coverage is in place, but it can get expensive over time, particularly auto insurance if you start adding kids onto your policy, and it's important to make sure you have the right coverages. So my first New Year's resolution is to review my property and casualty insurance coverage. Next one involves my children. I need to teach my kids something about money. Now, I have 4 kids. I'm not going to teach all 4 of them. Maybe I will. But my New Year's resolution, I'm trying to be small. I want to take one of the kids and teach them one thing about money, because my fear is that I'm not doing a good job teaching them enough about personal finance, which is really sad for somebody that's in the business like I am. So, next one, save more money for college. I want to put more money away for college. Now, I already have a kid in college, and I'm going to have 9 more years of college tuitions if everybody stays on time. So I want to be able to improve my cash flow so that I'm digging more slowly into the savings that I already have set aside. And it's amazing what only a few dollars can make a difference in. And then finally, save for a trip. I want to save up for a trip. We have several milestones in my family coming up in 2019, and I like to do a big family vacation at the end of the year. So Very simple goal. I want to put away that money so I have it available to pay the bill and not have to put it on credit cards. So those are my financial resolutions for this year. My thought here is that if I'm here next year, and I guess the station will have a lot to say about that, but if I'm here next year, I'm going to go through those financial resolutions and I'm going to mea culpa to the Money Pros audience to talk about how well I did on each one of those things. In the meantime, I encourage you to think about your own finances, review things for yourself, and decide what things you may want to do differently in your finances over the coming year. All right, so that's it for this segment. Up next, we got a viewer question on the HARP program for refinancing mortgages, so stay with us, there's more to come. Welcome back to the Money Pros. Good viewer question. It's something I've noticed as well, so I'm glad that they brought it up. So let's put it up on the screen. Viewer writes in and asks, I've been getting a lot of emails saying that there's a government program to help me refinance my mortgage called HARP, H-A-R-P. Is this legitimate, and how do I find out if I qualify? Well, it's kind of legitimate. HARP is actually a government program, and the best way to find out if you qualify for it is not to respond to those emails, but to go to harp.gov. The HARP program was created during the financial crisis in 2008. The idea of the HARP program is for those people that have FHA mortgages to be able to refinance the mortgages, but there's very particular qualifications. It's mainly, or it's specifically intended for people that owe significant amounts of money on their homes, so their loan to value ratio is higher than 80%. So they have little equity in the house, and normal refinancing would not be available to them. The problem is some less than scrupulous lenders are using this as a come-on to suggest to people that this is an opportunity to save money on a mortgage when the vast majority of people won't qualify. So my advice is check out harp.gov, see if you qualify, and then talk to your mortgage lender to see if it's a good idea. So that's it for today's episode of the Money Pros. Thanks for watching. We'll see you again next weekend right here on the Money Pros. Take care, folks.